geopolitical crises happening around the world at the moment. Our market managed to edge higher again today, ground up another 33 points. Started out with a reasonable report from BHP, which was taken pretty excitedly by the market first. And I think BHP got up to around about $39.30, closed just below $39. I think perhaps their iron ore result was reasonably well telegraphed to the market, and they realised that during the day. And of course we had the CPI numbers come out later in the day, with inflation bumping up around about the top of the RBA's target at 3%. So once again, Aussie dollar was reasonably strong, and there was multiple stocks to talk about. But David, we might start with you. What have you been up to? The market, not much of a correction just keeps grinding higher and higher and higher.
Yeah, it does keep grinding higher, and obviously the record low interest rates are seeing excess cash go into the market, Chris. Earnings, in fact, I think, are very sober. In fact, Deutsche Bank came out with a report today just saying that their expectations for EPS growth for fiscal 15 had come down 2 or 3% in the last couple of months, to about 6 or 7% EPS growth. And that was a function of three things. The first thing is just slightly lower commodity prices, cooling of China property, and industrial production in Europe flat year on year. The second point, I think, was just sentiment on the back of the federal budget. Obviously, spending has come back a bit and people are sitting on their hands a little. And the third point was just the Australian dollar remains persistently high against the US dollar. So those three factors, I think, have just seen earnings expectations edge down a bit. But very, very low cash rates are just seeing the market edge up a bit.
And the performance out of the US, their reporting season's gone very, very well. Apple, another cracker last night.
Yeah, so we've got these two markets. We've got the US that are hitting all-time highs on a regular basis, and we've got China that's still 65% below its 2007 levels. And Australia sort of seems to be somewhere between the two.
All right. Michael, what have you guys been up to?
Well, I think it's an exciting time in the market. I agree with David.
It's always an exciting time in the market, isn't it?
Yeah. Especially when reporting season's coming along. And there's a couple of companies that we have which we've got our eyes on, and we expect to see good results. But again, it comes back to picking quality companies and stocks. So I think the interest rates being so low. CBA yesterday, it's lending money at 4.99%. So it's the lowest it's.
Well, it's CBA, and then NAB followed them in pretty quickly after that. So it looks like there's a bit of a battle starting, but they don't tend to offer fixed rates for long for anybody to help anybody. So obviously I think it's going to stay or go lower over the next 6 months.
Yeah, but we're excited. So we've got our eyes on the markets, and we're buying good quality companies.
Okay. Well, look, Vodafone last night also came out with their result, and they're losing more and more customers. And Telstra seems to be getting very decent mobile growth. So I think half the market had taken profits $1 or so ago, and it continues to go to 4 or 5 year highs. I think it's about $5.45 today. At Montgomery, you guys looking in the telco sector?
Yeah, we still like the second line telcos. So, for example, iNet's one, Vocus Group's another, Big Air's a third one. So our preference, Chris, is we just find them better value and have much higher expectations of growth prospects.
So you're in TPG as well?
No, we're not.
No? Okay. No worries. Michael, what about Telstra and the telco sector?
Look, telco was one that we were big on in the past year and a half. TPG is a stock that we hold. It's a good company. It's just a sentiment, with this NBN talk that's going on. It's a bit of a risk. I mean, we've sort of repositioned our portfolios with telcos. We've moved away more towards the healthcare sector and companies that actually have earnings coming out in US dollars. So there's one ResMed.
Well, they report next first off, don't they?
In the US. And 76% of those companies in the S&P 500 have beaten expectations. So it's one that we have on the watch. But telcos, I mean, there's good companies out there, but just the sentiments there with the NBN isn't very much positive.
And I'm hearing quite a lot about let's buy stuff with US earnings in Australia, but the Aussie dollar just keeps bouncing up. It's back over 94 cents today. So I think people have done an about face. They keep trying to talk it down. What do you think is going to happen there?
Look, I think a lot of people are talking it down. But I think the Australian dollar is valued around 80 cents. So long term, I don't see it being around 94. And that again helps companies that are getting their results out in US dollars. But I mean, we've got a strong economy. Maybe the budget wasn't what people expected. But again, in our industry, it's about picking to good quality stocks and picking them at the right time and selling out at the right time.
Yeah. David, is currency playing a big role with what you guys are doing at the moment?
Not really, but there are a lot of very, very high-grade industrial companies that do have a lot of earnings from particularly places like the US. And they'll obviously at some stage enjoy a fall in the Australian dollar. It'll happen one day. I mean, we've gone off from record terms of trade. I don't think our terms of trade have been as high since the Korean War.
Right.
And they peaked again about 18 months ago, and they're definitely coming off the boil as commodity prices fall. So we've got this alternative view of volumes increasing, particularly in places like LNG and iron ore, but prices declining, that's obviously fairly crucial.
Yeah. Okay. Well, we'll start out with an easy email. North Star Mining. It's from Jason. He's recently come across North Star Mining, and due to its recent increase, I was wondering if this company is still a buy at its current price. Well, it's true that North Star is one of the few gold stocks that's actually been going in the correct direction. And most of the valuations I see out there still have it as reasonable value. I think it's very, I'm not playing much in the gold space at all because I've still got no idea where the gold price is going to go next. But if you're going to be in it, then I think North Star is reasonable. Michael, is it one of yours?
North Star, I mean, the gold sector we were looking at about 3 years ago. So on Sky about 3 years ago, I kept recommending Regis Resources every month.
Oh, right, yep.
They did quite well. But I just think, you should look at the macroeconomics. I mean, gold usually tends to perform quite well when there's uncertainty.
Yes.
North Star is a great gold company. At $1.81.5, it's climbed up really well. But I don't think in a low interest rate environment you're going to see gold prices rise as much unless there's uncertainty globally. We see markets crashing.
Yeah.
I don't see that happening anytime soon. And even though Northern Star is a very good gold producer. I think $1.80, $1.50, it's overvalued.
Yeah.
We were buying this stock at $1.20 about two and a half years ago.
Yep.
They changed management and the stock dropped. But the gold sector is something we're staying away from.
Yeah, fair enough. Listen, David, I think I can remember you being very firm about not owning Newcrest at about $21, $22, and it's now, what, $11.50 today. Are you back in the space at all?
Not at all.
Not at all? Just short answer. Okay, thank you very much. Look, another big call that's been coming out from some research reports recently was people taking profits on the major banks, which of course done very, very well, and switching into Macquarie. I think there's multiple valuations on Macquarie back above the $70 mark, 72, 75 from some of the more bullish. It had another good day today, up around about $1. You and Macquarie, David?
We're not in it, but I'd have to say I think Nicholas Moore, as the CEO, has done a wonderful job getting the ROE up. And what he's effectively done is he's withdrawn capital from low-returning parts of his business, and he's thrown capital at the very, very high-returning parts of his business. And I think that's taken some years to come through. He's obviously sold off some non-core assets and put them back to his shareholders. But I think bottom line is that the ROE of that business is now a lot higher than it was a few years ago, and hence the run from the lows of $16 or $17 up to $50 odd. So it's been a very nice recovery. I don't think we'll see 100 again for a long time, but certainly it's been a very nice recovery.
Yeah, it was definitely a long way down from 86 down to 17. Michael, Macquarie?
Macquarie's been, I guess, one of the major investment banks, and whenever you get lower interest rates, you run towards the banks, and it's one of the stocks we're holding. It's also the first companies to short when the market crashes.
Oh, right.
And so it's a great company. They're running very well, as David said. They can move. They can concentrate on parts of the business that are generating more revenue, and they've done a great job. So I still think it's got a way to go. I think as the market goes up, a lot of these investment banks and the banks do exceptionally well. And plus you get the yield from a lot of these banks, which helps and attracts investors.
Well, that's the big question as well. A lot of people have gone back to neutral on the banks. A lot of it have actual sells out on it. Very, very hard with interest rates so low to move out of the dividend-paying stocks. I'm sure it's got to happen at some stage. Are you selling, or what do you do if you've got cash at the moment?
Look, if I got cash, I'll put it in businesses that I'll use on a daily basis. I eat Domino's pizza. I like to buy Domino's stock. I like Ramsay Healthcare.
Yep.
Woolworths, companies that we consume on a daily basis. Those are the sort of stocks I like. And even though if there's a crash, they'll continue to do well for the next 100 years. But it's about, I guess, knowing when to buy it and when to move money around from one stock to the next.
Yeah. I hope you're not eating Domino's on a daily basis.
I had some tonight.
Yeah. David, I'll come back to you after the break. We're going to take a short break at the moment, but while you wait, give us a call, 1300 30 34 35, or email us at yourmoney@skynews.com.au. Welcome back to the shares edition of Your Money, Your Call. I'm Chris Kimber from Kimber Capital. Been answering question on shares with David Buckland from the Montgomery Fund and Michael Kodari from Kodari Securities. Still taking your calls, 1300 30 34 35. Emails yourmoney@skynews.com.au. Just before we go to our caller there, I just want to go back to Mr. Buckland. I didn't give you a chance to finish off on Macquarie and the four major banks that everybody's looking at every week because they've made a lot of money by doing very little.
Well, just with Macquarie, I think it's very important to point out that with these record low interest rates around the world, we're seeing a huge amount of merger and acquisition activity, particularly internationally. And obviously, Rupert's recent proposed acquisition of Time Warner at $80 billion is a case in point. And so Macquarie are often the beneficiary of a lot of M&A activity.
Yes.
They give a lot of advice, and then they're also involved when some of these private equity companies refloat those businesses back onto the stock exchange. So that'll really give them a bit of a shot in the arm for some additional earnings in the foreseeable future. Just back to the major banks, we quite like ANZ and certainly Westpac. We've never really been enamoured with the National Australia Bank for a long time. And Commonwealth Bank's obviously done superbly, but the share price is a bit hot for us.
Yeah, it's always been expensive though, hasn't it?
It has, yeah.
All right, we'll go to our caller, Brett from Sydney. Sorry for the wait, Brett. How can we help you?
Hey, Chris. Long time no hear. How are you?
Yeah, very well, thank you.
Yeah, good, thanks. Mine's regarding iCenter Group. It's a new IPO technology sort of business. I was reading the fundamentals. It looks very good. Technically, it's starting to look strong. I'm just wondering if either David or Michael, is it?
Yes, that's right.
Any opinion on the stock?
Yeah, no trouble. David's nodding to me off camera, so I'm going to throw it straight to him. iCenter, you had a look at this?
Yeah, we actually own it.
Right.
So it floated at $2.04 in early June. It's the old media monitor business. It's run by a chap named John Kroll, who's in fact his father started a division of the business back in about 1976 or 1977.
Oh, wow.
So it's been running a long time. It took over the Associated Press media monitor operations early this calendar year. So it has enormous market share in Australia and New Zealand. And I think it's also got a presence in about 8 or 9 countries in Asia. So it's popped up from about $2.04 to about $2.45. It's put on 20% in a bunch of weeks. I still like the tailwind behind it. I think it's certainly a go-to stock for a lot of corporations. What I mean there is, if, for example, Coca-Cola want to know anything about Coca-Cola, they need to get iCentia's information. And whether iCentia charges them $400,000 a year or $500,000 a year. It's an absolutely irrelevant for Coca-Cola or any other large corporation. So there's a little bit of pricing power, great sort of, I'll call them monopolistic connotations in Australia and New Zealand, and some good growth prospects in Asia. So I like it medium to longer term, Chris.
Okay, excellent. Michael, do you want to talk about that, or we'll go to the next caller?
It's done very well in the past month. Looks like a good company. It's just, I guess, it's not very liquid for us to trade in yet.
Right. Okay, fair enough. We'll go to Joe. Thanks for waiting on from New South Wales. How can we help you, Joe?
Oh, thanks for answering the call. I'd like Chris, David and Michael about 2 stocks. One is Pan Australia. Firstly, there's a takeover offer, proposed takeover from a Chinese company at about $2.30. Their opinion on the Foreign Investment Review Board approving this. And also Silver Lakes Resources with over 4 million ounces of gold reserves with no debt, and trading in a range of 30 cents to 50 cents. It seems unusual to me.
Yes, yeah.
I'd like those two comments. Thanks for this.
No problem, Joe. Thanks very much for your question. Look, just a couple of things there. First of all, Silver Lake, it's all about their cost of production. I think it wasn't so long ago that it was actually one of the cheapest on the boards. Obviously, we said earlier in the show we can't work out where the gold price is going next. So I'd say it's a punting stock, and I actually do own some, but not that I would recommend it to all of my clients. And also Pan Australia, copper stock, yes, under takeover, probably trading around about 10 or 20 cents below the average valuation out there. So if you held it, I'd still hold it. And if you have cash, I'd buy Sandfire Resources instead. But we might start with you, Michael.
Look, both of those companies were companies we were buying, it's about 2.5 years ago. So, good stocks, good companies. Again, SLR was trading around $3. They were expecting it to hit 10. A lot of analysts were saying it could reach $10, and it has dropped down to 50 cents. So, like a lot of companies in that sort of sector and industry. Look, my advice is I stay away. I don't get emotional to a lot of these companies, so I tend to move money around. So at this stage, we're way clear of mining services, any mining company, although they could have a very good story. Again, if the market's not really on your side and you're swimming against the wave, no matter how good of a swimmer you are, you'll be washed up for sure. So, we're staying clear of those two companies.
Okay, well, that's excellent to have that sort of discipline. I always find my greed's a bit worse than my fear. Balanced that way. David, either one of those stocks?
Not really. I just make the point with Silver Lake is you've really got to understand the cost of production of these businesses, and that includes things like how much rubbish they have to strip to get to the gold. And when you're talking about companies that are producing, 1.2 grams of gold a tonne, I mean, this is like a pinhead of gold versus a tonne of rubbish. And so it's, for a lot of these companies, their cash costs of production are well over $1,000 an ounce. And then they've obviously got depreciation, amortisation, exploration, etc., etc. So it's a very, very fine line, and a lot of it really comes down to keeping their cost base down, growing their production, and taking a punt on what the gold price could be in 6 or 12 months' time, of which most of us have no idea.
Yes, yeah, exactly. All right, I want to go back to healthcare. You mentioned Ramsay just before the break. Ramsay's my pick of the sector, and I've got most of my clients in that as the pick. Of course, it's been expensive again for a long time, and I think there's a hell of a lot of valuations out there saying it's expensive. I still like that. And then HealthScope, I'm a bit concerned because I got a very large allocation instead of a small allocation. So either Ramsay you like?
Yeah, look, Ramsay I like. It's a great company. No matter, look, valuations are interesting things. A lot of analysts can say the market's overvalued. But then again, everyone values the stocks or the market in a very different way.
Yes.
That's how you look at it. So, I still think if if money's cheap and you're buying into quality companies long term, you can't go wrong. And that's my message to everyone that's buying stocks or is in the stock market. Yes, you're going to get those dips, but it's part of the game. There's risks involved, but the key is to control your emotions, have a sound strategy. And Ramsay, they own so many hospitals. Over 60 within Australia, worldwide in France. Malaysia, so they've done very well, and I see them continuing to do better too moving forward. But in the short term, the share prices, had a bit of a hiccup, which is normal with most share price rises.
All right, I'm going to do it to you again, David. I'm sorry. We're going to come back to you after the break. Taking a short break. Please call 1300 30 34 35. Stay with us. I'm Chris Kimber from Kimber Capital. With me is David Buckland from the Montgomery Fund and Michael Kodari from Kodari Securities. If you've got a question about a stock or shares, phone lines are open right now, 1300 30 34 35. You can email us at yourmoney@skynews.com.au. David, sorry for cutting you off in the breaks all the time there. Ramsay Healthcare, HealthScope and that sector.
Okay, so Ramsay Healthcare, still like it, think it's fair value, great business. Healthscope was too expensive for us. The range in which they were trying to sell the business was a low of $1.77. We quite liked it at the low, but we certainly didn't like it at in the middle or the high point. Other health stocks that we like, CSL we like very much at the prevailing price versus its our assessment of its intrinsic value. Another one we like is Certex Medical. It's capitalised at about $1 billion, but we think it's got some very, very interesting prospects over the next few years.
Yeah, okay, excellent. Thanks for that. We're going to go to Michael from the Gold Coast. How can we help you, Michael?
Yes, thank you, panel. I want your opinion on Tattersalls, TTS.
Yeah, no trouble at all. Thanks very much. Tattersalls, I do have a fair few clients in the stock, really simply for the yield. I don't know how excited we are about the growth going forward, but yes, if you didn't have any, I'd hold it for yield, but except for that, wouldn't be in my portfolio. Michael?
Look,
or in this space, anything in this space?
Yeah, look, it's done very well in terms of share price, but you know, we see it as being slightly overvalued.
Yep. No, so no interest at this level. Would you stay if you were in there?
Look, if you're in there, you could stay. You know, it depends on how much risk you want to take, what sort of returns you're seeking.
Yeah. So, okay. Fair enough. David, what do you think?
Too expensive for us, Chris. So it's capitalised at about $5 billion. It's got a return on equity of only about 9 percentage points, which we don't like. One in the sector we much prefer is Ainsworth Gaming Technology.
He's got a new Bentley now. So.
He's got a new Bentley. I think he owns about 65% of that business, and it's performing very well. So that's one that we prefer over the Tattersalls business.
Okay. Well, what about, because I must admit I'm holding Crown as well, which has been sold down a little bit. Do you like Crown? At these prices? Yeah,
look, for us, value for money, it's still Ainsworth Gaming. It's a smaller of the three that we've just mentioned, but I think its prospects are probably the most exciting.
Yeah. Okay, fair enough. We'll go to Kevin from WA. How can we help you, Kevin?
Hi guys, thanks for taking the call. Look, I'm interested in your comments on AWC in particular. I own shares in both AWC and AAI, which is like the Alcoa parent company. I've noticed, certainly over the last month since their second quarter results, Alcoa have gone ballistic in the US, and I'm wondering how you think that might translate into AWC shares over here.
Yeah, look, Alumina's obviously picked up of late. I think it came up from $1 back to about $1.50 or something like that. Look, I think that if you're in AWC, and I have some, I'm going to stay long, but if you're in cash, I wouldn't be adding it to portfolio despite the parent company's great result. Michael, anything about that space?
Look, I agree. It's for us, it's hard to value a company. It hasn't made any money. So it's hard for me to value, but you know, I agree with your comment. If you got some cash, it probably wouldn't be my top pick to get into.
Yeah, I have a feeling it mightn't be your top pick either, David.
No, we like businesses that make money.
Yes, yeah. Well, that's fair enough. You did mention, Fox, which delisted and then just launched. Well, assumedly launched a bid for Time Warner. There's a lot of discussion going on in the papers at the moment about how much more Mr. Murdoch would be prepared to pay. Are you guys paying much attention to that?
Not really, but I guess we are from a sort of media ramification viewpoint, but not really from a stock viewpoint. But no, it's clear that you've got these two $80 billion businesses, and he'll divest CNN for reportedly $6 to $8 billion. So it'll end up, if it goes ahead, being worth about $150 billion. Yeah. So they're telephone numbers, these numbers, but clearly he's done remarkably well over his entire career.
Yeah. Michael, did you hold Fox when they delisted, or have you been paying attention to that at all?
It's a stock that we haven't been involved in. No.
Yes. Yeah. Okay. No, fair enough. We'll wait and see. Obviously, the market's a little bit concerned about how much gearing, how much debt Fox would take on. The first bid was only 40% cash and the rest was stock. It doesn't look like they'll go above that, but we'll wait and see if we get what happens next. Woodside is another one we got several emails about again today. So we're basically, Shell did the sell down. We got excited for a little minute because we thought we were going to get massive franking credits, but it turned out to be only for Shell. So I'm going to have to do that one after the break as well, just to keep you in suspense. We'll be back in a second. If you'd like to speak with our expert panel, call us 1300 30 34 35 or email us at yourmoney@skynews.com.au. Welcome back to the program. I'm Chris Kimber from Kimber Capital. Joining me on the panel tonight is David Buckland from the Montgomery Fund and Michael Kodari from Kodari Securities. Well, it's been a great show thus far, even if I do say so myself. But we've got plenty of time to answer your questions. 1300 30 34 35 or email at yourmoney@skynews.com.au. We're going to start with we're going to go back to Woodside. We'll do that in a minute. First of all, we'll start with an email, which is to do with Covermore. Tom writes that he wants to hear about Covermore. Do you think it's good value at these prices? That's nice and simple, isn't it? David, stock that you guys look at?
Yeah, so floated by UBS very recently at $2, has performed poorly in that it's now $1.80. It basically is a travel insurance business that also has a medical assistance side to its business. It's got a very large market share. So I think something like 40% of Australian travellers is its market share, and it also runs off Flight Centre's HIP. So most people that walk into Flight Centre or book via Flight Centre would typically get a Covermore insurance or medical assistance package. So what it's actually doing is, on the back of Flight Centre, it's also moving into places like the UK, parts of Asia, so for example India, China, other parts of Asia, and ultimately possibly places like Canada. I think it has very, very good prospects, some good optionality, and I think at about $1.80, it's probably reasonable value. Okay,
rightio, fair enough. We'll go to our next caller, Dane from Melbourne. Hi Dane, how can we help you?
Hi fellas, how you going?
Yeah, very well, thank you. What's your question for us?
Just wondering what the panel's long-term view on gas prices is at the moment, and in particular, there's a stock that I'm watching and I've been closely following it. It's called LNG, liquefied natural gas.
Okay.
It's just relentless at the moment and with no real announcements, and I'm just wondering if you guys have heard of the stock and what your view on gas prices is.
Yeah, listen, thanks very much. Look, I'm still quite bullish on long-term gas prices. I'm not playing that through LNG, though, so I'm hoping the guy with the laptop knows something about LNG. Michael, here's your hospital pass.
Well, I hope so. Look, it's done very well for a company that hasn't made any money, hasn't had any sales, and it's got negative cash flow. So, you know, I wish I could get into investments like this and make money from. But you know, it's one of those stocks that you know, there's a lot of reasons why stocks move up in the market. Sometimes it's based on fundamental basis. Sometimes it's based on technical basis. Sometimes, you know, the company's just been promoted. So, you know, this is one of those stocks that I'll be very careful of. I think it's had a very good run. You know, it's not something that meets our criteria.
Okay, no worries. David, probably not LNG, but gas prices or the space at all?
Well, one thing we've got to be wary of is there's a lot of potential gas production and export coming from other parts of the world. So Australia had this sort of really great free kick, and we're producing, I think, about $200 billion worth of LNG projects. At present, a lot of those are going from the construction phase to the production phase over the next 2 or 3 years. But the problem is that the cost of producing the gas now is so high that we will no longer have any new greenfield gas operations in Australia. A lot of them will be sort of extensions at the margin. But what's happening is that gas coming out of places like the US, if they can export it through the Panama Canal and get it to Asia, it is going to be a serious challenge to Australia long term.
Yeah. Okay. Excellent. Thanks for that, David. I'm just going to go back to you, Michael, because we just mentioned Woodside a second ago, which had another good day today. Was up to 42.50, I think. I still have Woodside for clients in their portfolios and myself. I did reduce my stake when the stock hit 42.20, which I think was the sell-down price for Shell several years ago. And plenty of fully valueds out there at the moment. I mean, it seems like more buyers on oil searches doing quite well at the moment rather than Woodside. Anything in that space?
Woodside, it's one that's come up in this program in the past 3 years, which I've said, you know, it's one that you can have in your portfolio. It's not easy to find good oil and gas companies, and Woodside is one that actually makes money. You know, it's got a track history. You know, although at current prices I see it as being a bit too expensive, it's had a good run. From that sector, if you want to have a portfolio diversified, it's definitely one of those stocks you can look at.
Yeah, okay. David, it's probably back to the same sort of topic. I mean, if not Woodside, anything in that space?
Look, for us, Woodside, we're probably valuing at $35, $36, so we'll just sort of sit our hands for that one.
Okay, fair enough. There's another thing that happened today, very, very strong nickel prices over the last few months. Nickel's up around about 20%, and Western Areas, which I must admit I hadn't looked at for some time, so I don't own any, came out with a very positive result. Clearly they've been benefiting from the higher prices. I think they actually moved into a net cash position, which has been a long time since that's been the case. There are some very bullish brokers out there predicting nickel prices will continue to rise very strongly, and I think they're valuing these guys at around about $7. But David, nickel.
Well, it's easily the most successful base metal, across the spectrum at the moment in terms of its price, and I guess BHP must be enjoying that Western mining takeover of many years ago now at last.
Yes, it's taken a while. Look, another stock that came up on several emails and clearly has been discussed for a while on the show is G8 Education. And I must say I'm in the stock now, but I was late to the game. So I know there was plenty of people that were in the stock at half the current price, back in the 2s. I only came in the 4s, and that was because I was a little bit concerned about whether the management would get very greedy in expanding and start paying over the odds for further childcare centre acquisitions. And the last time that they, I can't remember, I think it was Sterling or something, group, they actually paid a higher multiple than they said they were going to. So I am long now, and obviously the political situation is, helping the space. David, are you guys looking at that at all?
We have owned it. We don't currently own it. Look, it's a space with a great tailwind. Yep. There isn't enough supply of nursery and young children care in this country. On one side of the coin, on the other side of the coin, the company's management were adamant that when they made an acquisition, they weren't going to pay more than 4 times forecast EBIT. And they did make a very, very large acquisition at about 5.7 times EBIT. So you've always got to question a company when they suddenly break their golden rule. Now, their argument is that they didn't want a competitor, they didn't want a second company listed on the stock exchange in the space, etc., etc. But when you break the golden rule, often you get sin bin for a little while, and I think they're going through that at present.
Yes, no, definitely the case. It took a while to convince myself to buy some, but we'll see how we go. Michael, that or anything in the space?
Look, we've bought that stock.
Right.
Again, they've been acquiring their competitors, and it comes back to, are you paying too much for your competitors maybe? But it had a big drop. It's back up now, trading positive. In that sector, in the childcare sector, you just this is a company that's it's going towards growth, so it'll be growing, but it's got to be sustainable growth.
Yes,
you don't want a story like ABC Learnings where it explodes. So that's what you've got to be careful of. I think they're much far off from exploding, but they're geared towards growth. So you're not going to get a high dividend yield from them. It's mainly share growth, the stock price growth. So I think it's one you can add to your portfolio. They have made a lot of acquisitions, and they've been buying other competitors, which is a good thing, but you've just got to be careful. They don't buy too many too quick.
And as their balance sheet seems to still look okay at this level?
A return on equity of about 10.4%. The cash flow is increasing. One of the key things with a business like this is cash flow. If they've got the cash flow to continue to buy, that's great. But then again, you want them to buy at value rather than, pay 5.7 EBIT, which is a bit too high.
Well, that's a good question. David, would you buy it again if it came back?
I think so, Chris. It's one thing they've done is they've been very disciplined in using a lot of scrip when they make acquisitions. Or if they acquire through cash, then they have another capital raising. So their balance sheet's always been in pretty reasonably good order. And what it means by doing that is that their return on incremental capital isn't declining, and that's quite an important thing to look at, is return on incremental capital.
Okay, excellent. Thanks very much for that, guys. We're going to take another break right now, but of course we'll be back in just a second with more. Welcome back to the program. If you've got a question you'd like us to answer, please pick up the phone, call 1300 30 34 35, or of course, if you prefer, email us on yourmoney@skynews.com.au. Thanks for waiting on. Roger from Melbourne. How can we help you?
Yes, I got two questions. Thanks for taking the call.
Yeah, no trouble.
Two questions for the panel. There's a company called Progen Pharmaceuticals, PGL, a Brisbane-based company. It has been, Europe has given a new approval for a patent, the European Patent Office, and the share price has gone up maybe quite a bit of share price has gone up.
Right.
The second one is Boat Longyear, ELY, that is gone up 70% or something. What is happening there? If you can give us some information, it will be very nice of you. And I'm waiting for your reply, please. Thank you.
No trouble at all. Thanks very much for the call. Look, I'll just quickly start with Progen. I don't know if they're still doing the same thing they were a couple of years ago, but they were $8 or $9 and had a solution to delaying liver cancer. But clearly they blew up and went back down to 10 or 20 cents. If they've been running lately, you just said there's a patent come along. I'd just first of all check if they've got any cash in the bank, because that is a perennial problem for stocks in this space. But David, bought Longyear, or that's another one that's down into bugger all from where it was.
Yeah, so it's absolutely crashed, Chris. And the issue with this company is that it's highly operationally leveraged and highly financially leveraged. So it's basically a drilling business. I think it's located in about 25 countries around the world, and its capacity utilisation of its drills has gone from 60-65% to sort of 30-35%. So that's problematic. The other problem, of course, is its indebtedness. I think the value of its property, plant and equipment is something like $400 million, and the value of its debt is well over $500 million.
Amazing.
Like $540 million or thereabouts. So it's highly operationally leveraged. It's highly financially leveraged. I think its debt's been downgraded to CCC, which basically means it's junk. And so at 8 cents or 10 cents or 15 cents or 20 cents, it's just a gamble. I'd probably head down to Flemington and you get it all over and done within 3 minutes.
Listen, it saves a lot of time, doesn't it, rather than that slow pain.
But look, these things are about businesses that are highly financially leveraged should not be operationally leveraged, and vice versa. So if you're operationally leveraged like you are, you shouldn't have a lot of debt, and these guys have broken the golden rule.
Another golden rule. Michael, either one of those is a trade? I mean, clearly they've been severely beaten up, both stocks. So
look at those sort of returns of 75%, 40%. That's what you see in the casino. The view is a greedy man, which is good, but these sort of companies highly risky. PGL, negative cash flow, doesn't make any money. You've got to keep in mind raising capital is extremely hard for the biotech pharmaceutical sector. Again, bought Longyear. It could be another Forge case. We were trading Forge when it was going up 30-40% a day, and you've got to know when to get out, because if you don't, if the company goes under, there goes your funds. So you've got to be extremely careful when you're trading these sort of stocks. It's something that I'll stay away from.
Okay. It does bring up the issue about mining services, though, because there's several brokers have now gone back to a buy on Worley, and it's been a long time since that happened. Stock back up to about $18, of course was 30. Is it still too early to go back into mining services stocks?
Yes.
David, sorry?
Yes, in short, what's happening is that the space is going to be very problematic for a few years. And what's happened is that the majors have all completely battened down the hatches, and they just won't be spending money like they used to. So if you're a company that's, say, focused on infrastructure, where you've got a lot of government projects coming up, that's a different story. But if you're completely focused on the large mining houses spending a lot of money over the next 2 or 3 years, it's not going to happen. And as I said earlier, Chris, these enormous LNG projects, $200 billion worth of projects, are going from the construction phase to the production phase. So if you've been servicing those projects, you're going to have another nice year or two ahead of you. But after that, there's going to be nothing. It's going to be very much slower, and it's going to be quite problematic.
Fair enough. Michael, are you of the same opinion, or is there something in that space you've had a look at?
Well, it's interesting, you know, China 6-7 years ago had the ghost cities where they built all these cities with no people in them. Yeah. Now they're moving them towards those cities, and you know, our mining. Look, developing nations will continue to grow. It's just that you're not going to have the same growth rates. You know, I've got friends in the mining sector that own mining camps. They employ about 400 people, and they're moving away even from building mining camps. They're moving towards affordable housing. So there's a shift there, and usually comes from the guys from the top. As soon as they shift things, you know that there's something not right, and the demand is slowing down, which is what's happening in the mining sector. So it's an area that I, you know, stay away from. Anything, you know, at the moment there's not much gold, and selling shovels, you're not going to do well.
That's a good way to think about it. Okay, thanks for that, Michael. Sean, thanks for your patience from Melbourne. How can we help you?
Hi, I was looking at a pharmaceutical company, Star Pharma. I was just wondering if it was worth jumping on the bandwagon at the moment. It's gone up about 30% in the last 3 days, or is there something else in the industry? Yep.
Okay, listen, thanks very much. I think David was talking before about CSL, and I have to agree with him. And I know that's a very different end of the market, but down at $67, it's right. But Star Pharma is, Michael, have you had a look at that at all? SPL's had a recent rally.
Yeah, negative cash flow, hasn't made any money. Again, very hard in the pharmaceutical biotech sector. You know, it's something that I'll stay away from.
So there's nothing in that space that...
Any of the little ones? CSL is a good one. Again, it's like the oil and gas sector. You know, it's hard to pick a good one. Usually it's the larger ones that have a lot of funding behind them that do well. So these smaller companies, I'll stay well away from.
Okay, no trouble. Look, we're going to go on to car sales, which also had a bit of an average announcement today and came off a little bit, down to around about $11.20. It's a stock that probably most people have been bullish on for some time. It looks like there's a bit of a turnaround going on at the moment. David, are you looking at car sales?
Yeah, we own it and we still like it, Chris. I think with a lot of these companies, what they've done is they've done really well in their domestic economy, Australia and New Zealand. And what we have to do is we have to understand, can they actually do particularly well outside Australia and New Zealand, become global businesses or Asia-Pacific type businesses? And I think with car sales, there's a reasonably good probability that they'll end up in 2 or 3 countries, possibly 4 countries in Asia, over the medium term, so I'm talking 5 years, where they could end up with really, really nice market share in these 4 or 5 countries other than just Australia and New Zealand. And if they are successful in this, and we've seen this with a number of Australian businesses, if they're successful with this, then we'll look back and go, gee, that was actually an opportunity.
Yes, yeah. Okay, excellent. Thanks very much for that. It's time for a short break. Don't miss out on having your questions answered. Please give us a call, 1300 30 34 35. We'll be back after the break. Welcome back to the program. Unfortunately, we're coming to the end of the show, but we still have a little bit of time left to answer some more questions. So we're going to go straight back to car sales first of all. Michael, David likes the stock and they're still long, you know, medium-term holders of it. Are you guys in car sales? And also, we've got to talk about iCar Asia, ICQ, which has been, I think car sales now owns 20% of it, and it's sort of gone from 40 cents to it's $1.60. Are you going to be left hanging there, or is there some point that car sales might buy them? Anyway, but either stock.
They might as well do. You know, it's a very it's got a large market share, car sales. I don't see any competitors coming in and taking that away from them. You know, it's a stock that we owned, and you know, we're continuously trading car sales. So you know, it's long term, it's a great company. Short term, you know, we buy and sell the stock. You know, I like the online retailers, and you know, I think that's where a lot of money can be made. The risk is minimal within that sector. Companies like Flight Centre, again, you know, I see as being doing very well. You got Seek.com. You know, they'll always.
And
be
you're still happy with Seek at these prices as well?
We're still happy. You know, I think unemployment rates are high. As there's more business confidence, and they're advertising a lot more, you'll see more revenues for Seek. So you know, now could be, you know, around the bottom for them pretty much. You know, so the turning point hasn't come as of yet. But it's a good quality company. You're not going to get many with the same return on equity and increasing cash flow. So you know, even though some might say they're overvalued, I still see long term as being good opportunities.
Right. Okay. Thanks, Michael. David, car sales, yes. Are you in the smaller in the iCar Asia?
No, but we are also a big holder in Seek.
Oh, right. Yep.
And, you know, look, again, and talking about transitioning yourself, this is a business that has obviously enormous market share in Australia and New Zealand, and what they've done is intelligently use their cash to have very, very good positioning, again, in 6 or 8 really major economies around the world. And if they can become the number 1 or number 2 in these economies, and they're often 3 or 4 years behind Australia in terms of internet penetration, online job search, etc., etc., I think there's a very good chance we're going to look back in 3 or 4 years' time and say, gee, the international operations are completely dwarfing Australia, and this really is a superb international business.
Look, I'm long myself, SEEK, and do have clients along as well. There seems to be sort of a rush of downgrades coming through out there. Is it?
We saw today one of the brokers, you know, was a little, I don't know, sober on the Chinese operation, which they own 65% of, and recently floated on the NASDAQ. Yeah, look, I think the problem often is that running businesses and transforming businesses take years, don't take quarters or weeks. And this industry obviously has a time horizon often of about 38 seconds, not 38 quarters. And so what happens is you've got to try and find these businesses with wonderful tailwinds and sometimes be a little patient and sometimes just say, look, I accept that there'll be, you know, a quarter a year or 6 months every few years where the share price doesn't perform. And look at, say, CSL. You know, it's gone up many 10 times from its float price. It's probably gone up 100-fold, including dividends from its float price. And there have been many periods where it performed, you know, sideways or didn't do much. But if it's a great business with a great tailwind, it's best to be patient. Yeah,
that stock really does annoy me. I own it now, but I didn't get any at $2.50 back at that time.
Yeah, probably about 4 splits.
Exactly. Sorry about that, guys. It's all we've got time for today. So thank you so much to our guests, David Buckland from the Montgomery Fund and Michael Kodari from Kodari Securities. And of course, thanks to you, our viewers, for all of your calls and your emails. Until next time, I'm Chris Kimber from Kimber Capital. You can email me at chris@kimbercapital.com. Enjoy your evening.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.